In this video, I will cover how I reached my how I built my portfolio to the current size. Because from the outside, it can look complicated and challenging to reach. But in reality, it comes down to a few simple things done consistently over time. In this video, I'll be breaking down exactly how I built the portfolio and what actually made the biggest difference. Now, just to be clear, this didn't happen overnight. This has been built over a number of years through working, earning, and consistently investing along the way. And I think that's important because a lot of people assume it's down to a lucky investment. And full disclosure, I will admit the market's been pretty buoyant in the time that I've been investing, and that's helped tremendously. But it's not just lucky investments that help grow to a portfolio of this size. You have to take other steps too. So, for me, there's really three core drivers that are behind building large portfolios. And full disclosure again, it might sound like a lot of common sense, but I still think it's worth reiterating. I think the first main driver, I would say, is building your income and saving on costs. The biggest factor that has been increasing my income over time, the biggest factor in building my portfolio has been the fact that my income has increased quite significantly over time, and my costs haven't increased. Well, to some extent they have, but not close to the level of the income growth over time. And because at the end of the day, you can really only invest what you've got left over. So focusing on my career and increasing my salary and looking at how I can progress my work to sort of reach the highest levels of salary possible has played a huge role in allowing me to invest more. But I don't think that's the only thing you can do. I think other stuff that I've done is taking on side hustles that can generate money over time. So, for example, some of these side hustles that I've done, it's in my spare time. I sometimes participate in surveys. I get involved in customer research. I've done Amazon deliveries. It's just small little things that admittedly will take a lot of your free time out of work, but it just helps build more money to invest more, and I'm hoping in the future I'll eventually benefit through retiring earlier because of the amount I've invested now. And I think it's really important to get as much earning as you can in your early years to give time for that money to compound in through your investments. Cost savings, again, I think are a crucial point. If you allow lifestyle creep to keep track with any earnings increases you have, you just won't see the benefit of your increasing earnings over time. Now, sometimes that might be unavoidable. For example, if you're growing your family, you might just need to replace the car or something. But where I can, I always try to live frugally, and I think my focus is generally just to buy necessities. I will admit, at some point, I think I probably am too frugal, and I probably deprive myself of enjoying life as much as I should have because I want to invest more. So I think there is a case for having a certain amount of balance between living frugally and living frivolously, but I do think that keeping some of that frugality is important if you want to grow a portfolio to a large size. I think whenever you're purchasing, especially in larger items, I think it's really important that you should compare all options. So I would I'd probably say over 50, but definitely over 100. I would seek out as many comparison sites as you can just to try and give you as broader idea of what's the best deal you can get on, whether it's holidays, insurance, house purchases, car purchases, etc., etc. Just try and give yourself as much knowledge of all the options, check reviews, see what's best. And it's also important to consider whatever you're purchasing, especially large purchases, is what the maintenance costs will be over time. I ensure that all purchases I do make will be on cards that deliver the best possible rewards for using them. And this, again, it's something I'd monitor every year if I was you, because the best cards, I'd say, frequently changes. In the past, I've used Amex's, but I'm not tending to use Amex's at the moment. I think the Lloyd's Ultra card with its 1% cashback is a very good card, and I think the Trading 212 card with its 1.5% cashback is a very good card. There's also zero credit cards which have 0% interest, which would allow you to take advantage. Which will allow you to take advantage of higher interest rates than savings accounts if you pay back if you sure to pay off the card in full by the time it's due, but not paying any late payment fees, but taking advantage of that 0% interest card will let you essentially save money on interest over time. I regularly shop around as well on bank accounts, wanting to take advantage of the ones that offer the best deals for you at the time. There's been a range of good accounts over time. There's Santander's had decent interest with its Edge account saver. There's been Zopa with its direct cashback on direct debits. There's a whole range of decent bank accounts. It's kind of just what suits your needs best. I also tend to take advantage of the switch deals banks offer, because you can normally earn around £200 per switch, and you can do it with multiple banks, so it can build up quite a lot over time for each switch. I'd say the second pillar of building a large portfolio is making sure you invest consistently. You've got to invest regardless of whether the market is up or down, because it's hard to exactly time when is the best time to when the market's going to be at its highest or its lowest. And I've just found if you invest regularly, you're likely to catch more. You're likely to get the best return, because you won't miss out on the good days, but you will also catch some of the bad days. I just think you've just got to avoid trying to time the market, and you've just got to be consistent. I think the final important thing is just let the market do its work. A lot of my portfolio growth isn't just the initial contributions that I've put in from my salary. It's just letting it compound over time. Passive trackers, you could just generally leave them invested in those passive trackers, and they will do the work over time. It's not complicated. Just staying invested will allow your portfolio to grow. I ensure to regularly reinvest all my dividends, because although it's nice to see that extra money come into your bank account, that extra 1 or 2% each year can make a huge difference over time. That's another reason you've also got to focus. You've got to keep an eye on the costs of whatever you're investing in, because high expense ratio can really eat into your returns over time. In terms of what I invest in, most of my money is going into index funds and ETFs. But I tend to invest. I also keep a bit of money for individual investments, and part of that is just because I do enjoy doing the research on individual companies. But I don't tend to consistently buy and sell. I do prefer a long-term approach, but I do like individual picks occasionally. Another important thing is focusing on where you invest. I think pensions and ISAs are really important for you to build your long-term growth, especially with the huge benefit of the tax savings you can get. I tend to slightly prefer pensions just because of the tax savings you can get on the individual contributions. It can really bring about huge tax savings if you're earning, especially if you're earning over 50,000 a year, because you could be at that point you're saving nearly 40% on your contributions, and even more when you're an additional rate taxpayer. I will if I've fulfilled my allowance of both my pension and my ISA, then I will look to use a general investment account after that. And this structure really helped me to make the most efficient use of my tax efficiency over time, and has played a big role in helping grow my portfolio to the size it is. That's not to say I haven't done everything perfectly in my life. There have been times where I probably should have invested more. I think one of the biggest drawbacks I have, or I'd say criticisms of my own investing, is when I do the individual investing, I definitely believe I should have more faith in my convictions, because I would say there are companies where I was very confident that the company was at a deep discount, and it turns out I was correct, but I'd only placed a small amount with them, and I probably should have had more faith in my conviction, and had I invested more, I would have had a greater return from it, and I would be sitting here with a larger portfolio today if I had. But make sure to manage your risks. Don't go too over the top, because you don't want to, because you can make the wrong choice. So you've got to work out what balance you feel comfortable with. Like everyone else, I see my portfolio going up and down, but especially in these recent times, which have been a bit more turbulent. But sticking to the plan, it's the most important thing. As long as you follow what your key plan is, you should see portfolio growth that is strong over time. If you chop and change what you're investing in too much, it's probably going to harm your returns. If I had to summarise, building a portfolio like this really comes down to three things: increasing your income, while also ensuring your costs don't increase as much at the same time. Invest consistently, and stay invested over the long term. It's simple, and it sounds really easy to say, but I promise it's not always easy. It can be really quite. You just don't want to be too stressed out by what you invest in. So make sure you feel comfortable with what you're investing in. I'll keep sharing up my updates on my investing journey, including the ups and downs. I hope you found this video useful, and I hope you all had a great weekend. Thank you.